it's very attractive to make comparisons to history, but very difficult. Mark Twain, the American author, said, "History does not repeat, but it does rhyme." In other words, it doesn't repeat. It's never the same. It's always different. Every cycle is different in terms of the length and the violence of the fluctuations, but also the causes and the effects. And we've never had one quite like we've seen in the last 2 years. First of all, the events of 2020 were not naturally occurring cycles, like most of what I've lived through. The events were not internal to the nation or the markets. They were external. We had the pandemic, which has never been seen before in 100 years, and where it was what we call exogenous. It came from outside. So it was, people ask me, which cycle is this like? And this is unique. Most cycles occur because optimism gets too high and events become too positive, which is unsustainable. And then things soften and we go to an excess of negativity and vice and back and forth. This was not a swing of psychology or a swing of the economy. This was an external event. And then, of course, the recession that we had in 2020 was not naturally occurring. It too was man-made, exogenous. It was the result of the Fed and Treasury manipulation of our economy to save the world. And I don't use that expression loosely. I do believe that if the Fed and Treasury hadn't done what they did, we would have had a global depression. So I think they were the right thing, but I think that the economy, which was the analogy I use, is putting the patient into a coma to save him until an operation can be performed. That's what the U.S. did to its economy and much of the world. They put the economy into a coma. It could be held in place until the rescue worked. That was the lockdown, of course, the coma. The oil shock, which ensued from the OPEC oil embargo of 1973. And of course, that is probably the best analogy in terms of an external influence at work. And it was profound. Now, the problem is that it was 49 years ago. The number of people who remember the analogy are few, but it was very strong. The force of the embargo itself, which means you couldn't get oil, people were lined up around the block for oil. We had rationing. You could only get gasoline every other day and so forth. And then it contributed to and caused inflation. And that, of course, that's another analogy to today. The price of gasoline went up, all costs went up. That triggered cost of living adjustment clauses in many union contracts, which caused prices to rise, which triggered further cost of living allowance. So we did have very strong inflation in the 70s, somewhat related to the oil embargo, but also created to the development of inflationary thinking. And I think in this country, we were on the way to developing inflationary thinking. Now, lastly, of course, we have the invasion of Ukraine. And this is probably the strongest, the most prominent military action of the last 75 years, involving well, the risk of two of the great powers going to war. Right now, we have one involved, but the others, they're possibly implicated. And so, and this, of course, is frightening psychologically. I think that if you ask the average person, well, what do you think the war in Ukraine is going to do to you? I would say that they would probably say, well, probably nothing physically, and maybe something economically in terms of difficulty of getting fuel or inflation or so forth. And yet it's having a very strong effect. What I want to point out there is this, and this is an interesting phenomenon for your viewers. This market, people had complained that it was too high. Some thought it was too high, some thought it wasn't too high. but aspects of the market, well, actually most of the market, from early January were on the way down, and weak and susceptible to bad news. You know, there are times when the market, when it's strong, sails right through the bad news, ignores it, and goes on to new highs. There are times when the market is susceptible to bad news, and it causes further declines and acceleration. And you know, the Ukraine situation sort of was the latter. And so when you throw bad news on a weak market, you get declines, and that's what we're having. You know, the question all along was whether the market was irrationally high. Some people said it was a bubble, and you know, I never thought it was a bubble. A bubble means irrationally high. I thought the market was rationally high given the low level of interest rates, which cause asset prices to be high. I thought that the market was rational relative to those interest rates. The only problem is that interest rates look to go up, and in fact they have. So the market's down a bit. The S&P is probably down 10% from its high, roughly speaking. That's what we call that. It has passed the threshold for what we call a correction. But you know, I continue to believe that the market is not too high for the current interest rates, and is not susceptible to an enormous crash from here unless we get the worst of news from Ukraine. You know, I'm not saying the market is attractive or a bargain, but I'm saying that the downside risk, I don't think, justifies getting out here. And it should be noted that the market is much higher than it was when the pessimists started to yell bubble. It has made very good progress from that point. Number one, it's certainly a correction because it's down more than 10% according to the S&P. And healthy usually means deserved, which it probably is. Prices were high, and interest rates have gone up, which would cause them to fall. And healthy because it eliminates some excessive optimism, and it brings the market to a more attractive level. So I would say that it probably is a healthy correction. But I must stress to your audience that healthy corrections happen all the time. They're not a terrible thing. They're not something to be feared. The market does not go up in a straight line. Sometimes it goes up, sometimes it goes down. Sometimes it goes up too much, in which point it has to either slow its rise or decline to be back to what you would call healthy level. And this is a normal fluctuation. They're never pleasant when you go through them, but these downward fluctuations are not in themselves a reason to get out of the market. I think people who sell things for the reason that they're down are making a mistake. We want to buy things when they're down, not when they're up. As they fall, it should increase our motivation. Warren Buffett says, I like hamburgers, and when they go on sale, I eat more hamburgers. Well, a decline in the stock market is the equivalent of stocks going on sale. And I would agree with your assessment. A healthy correction. It was somewhat high at 4,800. Now at 4,300, it's off 10%. It's more attractive. It could go down more. I'm not saying it's not going to go down. Nobody can ever say that. But ups and downs are not to be feared. And what's most important, as you know, Van, is the long-term hold. The S&P 500, for example, index of stocks, grown at an average of 10.5% for the last 90 years. And that is I would call that what Americans call a gravy train, a good ride that you want to participate in that ride. You don't want to jump in and jump out and jump in and jump out, because if you get worried here about Ukraine, nuclear, China, Taiwan, whatever it might be, if you get worried here and you jump out, you might fail to jump back in, and you might miss the long-term ride. So I think, in the long run, investing is invariably successful. People who've been on for a long time have made a lot of money. As one of my friends said, the key is time, not timing. It's very important to be an investor for the long term, wherever you live. All styles of investing and all investors have a bias. Some are more optimistic and more aggressive. Some are more cautious and protective. Some claim to be able to be aggressive when the market goes up and defensive when it goes down. That is to say, to do it perfectly. But I don't think anybody knows enough and is agile enough to switch from aggressive to aggressive to defensive at the right times and play the cycles correctly. Very, very few people. Well, first of all, there aren't many opportunities to do it. And secondly, there aren't many people who can do it right. Now, I would say that at Oaktree, we have a bias toward caution. And, I pioneered in '78 the investing in high yield bonds. The high yield bond fund I started at Citibank in 1978, I believe it was the first high yield bond fund from a mainstream financial institution. And the distressed debt fund that Bruce Karsh, my co-founder of Oaktree, Bruce and I founded in 1988, I believe, was the first distressed debt fund from a mainstream financial institution. And we've pioneered in these credit areas for a long time. But initially, when we started in each area, to get people to invest, we had to promise them cautious investing. We did not think it was appropriate to take an aggressive approach in a risky area. We thought that the winning combination was a defensive approach in a risky area. We wanted to be in the area, but not with the full risk. And so the clients came to us. That's essentially what they got, and they're happy for that reason. There are other people who deliver higher returns when the market goes up. We're not maximizers in that sense. And then they also lose more when the market goes down, either higher highs and lower lows, or lower highs and higher lows. And the latter is pretty much descriptive of Oaktree. So you're right. We have been able to do relatively well in bad times and from bad times. And of course, our distressed debt funds are, or what we now call our opportunities funds, are I think, very good way to take advantage of weakness. We don't make money in the weakness, but the weakness creates the foundation for our subsequent profits. First of all, I want to point out that I'm no economist. They are economists, and they probably know better than I am, an expert. However, I think that the people who work in places like the Fed, economists, tend to overestimate their ability to manage these things perfectly. So I think that the Fed was very smart to encourage the economy positively in 2020 and pull it out of the pandemic-related recession and lockdown. And I think that the Fed is going to discourage inflation now. So I think they get a good mark, but I think they're not perfect. And they wouldn't say they're perfect either. So the question is whether they can use these tools perfectly. And, we tend to think not. So right now, the Fed is slowing its bond buying and will eliminate it, and is about to start raising interest rates to choke off the inflation, which has been seen over roughly the last year. So the question is, will they get it exactly right? And it's hard to think that of anybody getting anything exactly right, especially in as uncertain an area as economics. They'll either do it too little, inflation will not respond, in which case they'll have to amplify their efforts, or they'll do it too much, whether at first or on the amplification, and then that'll hurt the economy and cause a slowdown, ultimately perhaps a recession. Many Fed rate increases give rise to recessions. So the ideal getting it done perfectly would be what we call a soft landing. We get the economy to slow down, not so much that it goes into recession, but enough to choke off the inflation, which is a great thing to aspire to, but which is hard to produce. And, you know, I given my experience, I do not expect perfect solutions most of the time. Oaktree really does not believe in forecasting. I think I think it's very important to know what you don't know, and there are many people in the investment business who think they know what the future holds. I don't. We don't. That makes us think about our risk and limit it, and that makes us apply limits to the things we think we can do in the markets. And I'm not smart enough to know about a new era. I do believe that most of the time the world goes back to roughly as it was. We've had many new eras proclaimed in my lifetime. Not too many have come to pass. And the ones that did, when we got a new era, it was usually unpredicted. So at Oaktree, we have an official rule that we do not base our investments on forecasts. We base it on what we think is the value of companies and industries and securities, the small things that I think you can know. And we don't claim to know more than other people about the direction of the economy or interest rates or currencies or commodities or the markets. These are macro things that nobody has a very good record of predicting. So we're going to stick to finding good companies, buying and holding their securities as long as we can. And it has what has proved out in the past. And to have a risk-conscious mentality so that we think about what can go right, but also what can go wrong, and we try to guard against it. So, you know, my own thought model during the pandemic was that 80 or 90% of the people would go 80 or 90% of the way back to normalcy. And I think that is on the way toward happening. And things that we thought would never happen again, like riding on a cruise ship and so forth, they're happening again, and life is going back to normal. The war in Ukraine will upset that, will interrupt that for a while, but I think we'll continue to progress back toward what we used to call normalcy. And it's the trend of people to behave as they always have is much more dependable than any individual's forecast of a new era. So look, if you say there'll be a new era and it turns out to be true, then you're a smart man and people should have followed. But most predictions of a new era do not come true, and I would not want to rely on them. I'm not a technology investor. I'm far from a technology expert. Nobody should take my advice on that subject. As I said, a man should know what he doesn't know. I don't know the answer to that question. I know that that technology is more and more important in our society every day. And if you can find, the next Amazon or the next Apple, it's a wonderful thing. The problem is, like the other things in the investment business, these things are hard to predict. And somebody will find a stock and they'll say it's the next Amazon. It will be the next Amazon. Many other people will find stocks that they say is the next Amazon. It won't be the next Amazon. So this cannot be done with certainty. It cannot be done with low risk. But it's worth trying because Amazon was $6 a share 20 years ago. And the last time I looked, it was $3,300, up roughly 500 times. I would say, you have to find businesses that can be popular, can resist competition, and can be profitable ultimately. Not in the beginning. Yeah, these companies run losses while they're being born and growing into companyhood. But eventually, of course, they have to be profitable. You can't have a great company making something for $5 and selling it for $4. Eventually, your sales price has to go above your cost. But this is what you must find, and it's worth looking, especially for those in your audience who are knowledgeable about technology. I think it's a good idea. As I say, that doesn't include me, so I leave myself out of that search. I don't play there because I know what I don't know. Again, but if you can do it, it's a great thing to do. Just you should never assume that you are correct to the extent of putting vast amounts of your money in any one situation, or even in this whole program. But once in a while, making an investment out of the belief that something can be a winning technology company, it can be successful, but it's no easier, and maybe it's harder than any other task in the investment world.
My pleasure. Just let me say that, I like South Korea quite well. Mm-hmm. I've been there quite a few times. And I have 4 grandchildren who are half Korean. I have a Korean daughter-in-law. I like Korea a lot. First, I am a writer. I've written for a long time. I've written in a lot of places. I wrote for 32 and a half years for Forbes every month. I currently write columns in monthly or close to monthly in 15 countries, few of which are in English, most of which are in native language. And I only am able to do any of that, including the 11 books, because I've got this firm with a big research department and people internally that write. So, for example, with the books, not all of them, but with most of them, I would sit down with someone in the firm that would put together first drafts of things for me. Or I would lay out the way I wanted it to be, what we would cover, how we would do it. This would be somebody inside the firm, inside the research group, already knew how we do things, what we think, where to get things from, how to put it all together, get me the data, all of that, put it together in a first draft, and then I would polish it up into the final draft with a little bit of me re-editing myself, the way good writing is rewriting. It's not just writing. And I am a writer, so I know I want it to be my voice, my words, but I get the stuff prepared, and I have a lot of support in the things that I, for example, now write in columns overseas. I've written a lot of things in Chosen Mint. And again, we have internal translation capability. So people inside the firm that actually can understand what it's supposed to be like can do a better translation than if you just hire a translator. And so we put a lot of effort into that, and then we deliver finished copy to the newspapers or magazines. So I don't know how much you understand about that, but for example, I write in what's sort of the equivalent of Italy's Wall Street Journal, Il Sole 24 Ore, which is the 3rd largest newspaper in Italy. I write in Danish equivalent of that in Denmark, Borsen. I write in Focus Money in Germany, another version of that called Trend in Austria. All of those are in native language. In Spain, in Belgium, La Libre, the largest French newspaper, in the Netherlands, the Telegraph, which is the largest paper, Taiwan and Hong Kong, and Via Caixin in China, and then in Singapore, and in Japan via Diamond Weekly. So but all that would be impossible if I didn't have support from the firm to help put it all together. So here too, with the columns, I talk to there's a group of people, I lay out for them the way the column's supposed to be for this country, aimed at that country, targeted at that country with information about that country. and then they put the draft together for me, and then I finish it off. It goes to the translator, the translator finishes it. That's the way that works. First, I believe that where we are right now is in a almost picture perfect correction inside a bull market. Corrections typically being defined, of course, as moves off of a very broad-based high, like the Morgan Stanley world, of 10 to 20%. I mean, of 10 to 20%, but not bigger than 20%, and not lasting very long. In the history of the S&P 500, there are many of these that have occurred. About half of them have been shaped like a V, straight down and straight back up. About a third of them have been shaped like a W, down, up, back down, up again. And then there's a smaller sliver that have had funny shapes. This one so far looks almost perfectly like a V-shaped correction. It is, compared to the average one for the history of the S&P since 1925, as I speak today, it's exactly been following the pattern of the average. That doesn't mean it will. I don't believe that what has happened over a few weeks is predictive of what happens after that, but I believe this is a correction. Secondarily, I disagree with what you said in that I think almost everything, going back to markets never forget, that almost everything we're seeing now is not unusual. We've seen all these things before, just with different faces on them. So we've had many regional wars, many. Every correction in history is always paralleled by talk about how you have things that are the worst and the first, and it's different now. That's always true. This one, the war is one of them, the Ukraine war, the truly tragic feature of Russia doing what I consider to be truly stupid activity and cruel and brutal. And I have tremendous empathy for the people in Ukraine suffering. But we've had many regional wars. The only wars that have ever caused a bear market have been world wars. Regional wars don't do it. We know that because we've had a lot of them. Secondarily, we've had a lot of periods where inflation's picked up. I understand why people fear that. I understand that many people get hurt by it. I understand that in parallel, there is the fear of rising interest rates. But let me just make some simple points. We have a history in the past of rising interest rates and what's happened. We have a history in the past of periods when inflation has risen. And the beginning of inflation taking off from a base has always been good for stocks 6, 12, and 24 months later. The numbers on that looking out 12 and 24 months are positive 80% of the time and are consistently double digit. Inflation, if you think about it, forgetting about interest rates for a second, just inflation by itself should not be by itself a negative for stocks because inflation is all kind of prices rising. And stocks represent the ownership of business. And just like real estate tends to go up in inflation, why wouldn't the value of the ownership of businesses increase if what inflation is the diminution of the value of money? Second, I'm going to try to do this with my hands, but going back to 1925, we have this history where inflation rose and rose and rose and rose and rose. And then inflation and long-term interest rates peaked in 1980 and then fell until just recently. Wiggling along the way, of course, wiggling on the way up, wiggling on the way down. We also have over that entire time period a history of daily stock prices that's good with the S&P 500. We can say the following things. Long-term interest rates in America, in Britain, where we also have a pretty long history of accurate data, In Germany, where the history of data is not as accurate, but it's still, there's a long one. It's not as accurate and long. The longest accurate data comes from America. The second longest accurate data comes from Britain. There's a lot of countries that have stock markets where we don't have a long history of good, accurate data. But where we do, you can just simply say, and I say this to people all the time, and it's in my Markets Never Forget book, and it's in a number of other books that I've written, people should look to see what the correlation between X and Y is if they possibly think X causes Y. And the actual correlation between rising long-term interest rates and stocks is positive. It's not negative. In the United States, since 1925, it's 0.33. If you think of correlations where one would be they move perfectly in lockstep together, and -1 would mean if one goes up, the other goes perfectly down. 0.33 is not a very high correlation, but it's still positive. It says stocks tend to move up with rising interest rates, and they tend to move down with falling interest rates. Then we can come to the point of concerns about the central bank. Now, if you've read me before, and I know you have, I've never been a believer that central banks are very good at dealing with monetary matters. I learned this when I was very young from a legendary monetarist, Milton Friedman, who was of the view that the central bank would always do the wrong thing because they think about it the wrong ways, trying to fiddle with interest rates instead of trying to grow the quantity of money at a desired steady state. And focusing on the quantity of money, instead they focus on interest rates. He said they always would. They have ever since. He's been dead for a long time. But their focus on interest rates is something that everyone else pays attention to as well. And there's also the concern that as the Fed raises short-term interest rates in America, that would be bad. We also have a history of when they've done this before. And the fact of the matter is, from an initial hike from the Fed, which they just recently did, we can also measure what's happened to stock prices 6, 12, and 24 months later. And they're again consistently positive. There is the potential for the central bank to do serious mistakes. And they may, but just raising interest rates a little for a while doesn't, which is very wrong-headed, that believes that the yield curve is flat and inverting. And you've probably read a fair amount about that. The focus being on the spread between 2-year treasuries and 10-year treasuries. The spread between 2-year treasuries and 10-year treasuries is basically unimportant. It's thought of as important by people who don't really understand how things are different today than they were 40 years ago, which is revealed by a different history. If you went, the core business of banking, the only reason the yield curve is important in the first place is what it implies about future lending from banks. Because the core business of banking has always been taking in short-term deposits as the basis for making long-term loans. So the spread between short rates and long rates has some importance because banks take in short-term deposits. That's their cost of money, which they then use to lend at long-term rates. And when that spread is tiny, the only way they're going to make money is to lend to a lower quality customer than they borrow from, which is inherently risky. In the past, when short rates have gotten above long rates, because the central bank has been in a desire to fight inflation, pushed short rates above long rates. Once you get the 30-day rate above the 90-day rate, you start to pull the 180-day rate up, and then the 1-year rate, and then the 2-year rate. And there's always been a lag time as that's occurring. And from the time you first get the 30-day rate above the 90-day rate, there's traditionally been about 9 months or a year before you've seen a stock market effect And that's just about the time the 2-year gets above the 10-year, which is the reason they think the 2-year, 10-year is important. But in reality, what's different now than 40 years ago is that 40 years ago, most of the bank deposit base was in time deposits, 65%. Today, only 7% is in time deposits. The fact is, that means the deposit base upon which banks lend is 100% not linked to any longer term maturities. It's all the equivalent of 10-day rates. And the average cost on those for American banks currently, of which there's a couple of different kinds, but the average of the kinds is 9 basis points, 9 100ths%. That's minuscule. So think about that in a world where 10-year rates have gone up to 3%. Even as the Fed has raised short rates with its first hike by 25%, you still have a spread between there and 10-year rates that's 2 3/4%. Another way to say that is all this year, the yield curve that matters has actually been getting steeper, not flatter, and no one notices. The spread between the very short term and 2 years has gotten steeper and steeper all year long. That no one notices that as a stunning statement of people paying attention to the wrong thing. It, that they haven't paid attention to, is bullish, not bearish, if you follow that. So the reality is a line that I use often, that I used in Markets Never Forget, is that fear of a false factor is always bullish. Because the fear is in the marketplace, and if the fear is about something that isn't really true, when the world comes to realize that, they'll have to reverse, and that'll buoy stocks up. And the fear of the rising interest rates, the fear of the inflation, is fear of what inherently at this moment in time is a false factor. I agree that the inflation hurts a lot of people. Markets are not kind. Markets are not cruel, are not caring. Markets are basically cruel and heartless. And markets are always pre-pricing the next approximate 3 to 30 months off into the future. And in reality, the inflation that we have is not so much traditional monetary inflation as bottlenecked inflation, supply chain problems that were initially from the on-off circumstances of COVID, and then are augmented by the sanctions from the West on the war. And all of that makes it much more expensive. The sanctions require distribution supply chain mechanisms to have to reorient. And whenever you reorient, there's a cost to that. All that will get worked through, and it'll take some time, but it will get worked through. Inflation will come down. If that was not the case, we already would have much higher long rates than we have. If we were to have 8.5% inflation over the long term, you wouldn't have 3% 10-year rates. It has to go away. The interest rates are also pretty good pre-pricers of the future. But the traditional view of monetarists is very consistent with the notion that trying to fiddle with Fed fund rate is a bad way to guide policy. Real desire should be to have money be as stable in value as possible. And this is the part where decades ago, Milton Friedman said they shouldn't be fiddling with interest rates. And his thinking, I believe, derives directly from that. And that's right, but I don't think that's what today is about. I also think and believe that money isn't what money used to be. In the days when Milton Friedman was first writing, the definition of M1 was cash and checking accounts, and M2 was cash and checking accounts and savings accounts, time deposits. Now we have M4, But an awful lot of what people spend today is spent in other ways. Money is what you use to buy and or sell stuff and or services. Whatever the stuff is, whatever the services are. And today there's a lot of digital transactions. Today there's a lot of credit card transactions that never used to exist when those theories were evolved. And I don't believe that the money measures are actually very accurate anymore. But the best thing the central bank could do, which it won't, is to give up the notion that it's going to govern economic policy by fiddling with interest rates, and instead aim at trying to create stable money. Because ultimately what money is, in a different way, is it's just like a ruler or a measuring stick that we use in engaging in transactions. And we should expect that to not have the meter or the foot bouncing around. We should hope the meter or the foot stays the same length the whole time. And we lack that as a central bank fiddles with things. So when you go back to COVID, they tried very hard to say, we're going to try to offset the economic problems we envision by doing these things, quantitative easing and et cetera. All of that is misguided policy. All they should aim at is keeping the value of the money stable, but they won't. You know, William McChesney Martin was the longest running head of the US Fed ever, from the 1950s into 1968. And when he was the best, when he became head of the Fed, he was the best trained guy up to that point in time to be head of the Fed. And he made a lot of mistakes. And people asked him why he made the mistakes. And he said, when you become head of the Fed, you take a little pill and it makes you forget everything you ever knew. And it lasts just as long as you're head of the Fed. And he was succeeded by Arthur Burns, who was even better trained to be the head of the Fed than Martin had been. And Arthur Burns made a lot of terrible mistakes. And after his 8 years was asked why it was that he did all these things that he had been trained better than to do. And he said, I took Martin's pill. And the reality is, I think mostly they all take Martin's pill. Certainly, the current head of the Fed has taken Martin's pill. It was only last fall when Chairman Powell said that inflation would be transitory and wouldn't last very long. If he was wrong then, which he clearly was, why couldn't he be wrong now? And the answer is, of course, he could. But it is a mistake for them to think that by fiddling with interest rates, they actually can regulate the economy. They can't. Money will flow around the world to where it will be most utilized, and they can't stop that. I mean, money will flow from America to Britain, or from Britain to South Korea, or from South Korea to Singapore, or from Singapore to Israel. And it will do it so fast and so cheaply today that, and by by global corporations and by traders, that for them to think that their fiddling is actually going to be smarter and more capable to deal with our economy, your economy, than what the markets will do in response is a largely arrogant, ridiculous view. But that's just my view, which might be arrogant and ridiculous too. It would really be what I prefer to view as the Fed's inclination to do stupid things. But the reality is, and let me just kind of take you back through some basics. Remember, we said earlier that the core business of banking has always been taking in short-term deposits as the basis for making long-term loans. I also said that the central bank should, but won't, focus on stability of the quantity of money. How is money created? How does a central bank like any of our central banks, yours, the United States, Eurobank, Bank Japan, how do they create money? In any fractional reserve banking system, money is created and only created by the banking system increasing its net outstanding loans. And I believe today that the best single proxy for how much the quantity of money is increasing is by how much the total net loans are increasing, because that is the mechanism that's used for creating the quantity, new money. If we think of what the Fed has normally done in times in the past, where to fight inflation, it's engineered recession, what it's done is push short rates above long rates to choke off lending. That's why they raise rates up, to choke off lending. The reality is what they should focus on is not the rates, because they're not good at doing that. They should focus on the lending. And yet what I would say to people in South Korea or anywhere else is that as long as the spread, because of what I described before about the bank deposits, between very short-term interest rates and 2-year rates remains 1%, 1.5%, 2%, there will be abundant lending. And we won't be forced into recession by anything the Fed does. Now, let me just say, you can get recession for other reasons that aren't from the Fed. But in terms of the fear that the Fed would engineer recession, that won't happen as long as there's an adequate spread for enough lending to go on. And that's the answer to that question. I think the way you look at that is, does the Fed shrink the spread between 30-day rates and 2-year rates to get it down to be very small, or get 30-day rates above 2-year rates, which would kill lending? If you kill lending, you will kill the economy. If you kill bank lending, you'll kill the economy. Two reasons. One is that if you look at everyone that's in that book, they're all people that had passed away. So, for example, you don't find Warren Buffett in the book. Mm-hmm. And once I set up the principle that they would all be people who were passed away, and I did that because when you write about someone, sometimes if you say something that you think is right, but they don't like it, you make an enemy out of them. And I didn't want to do that about anybody. So once I set up that principle, then I didn't want to include my father separately, because why would I include my father when everyone else that might have been considered that was alive now or at the time wouldn't? And then the second part is I didn't want to sound like I was bragging about my father. In my capacity writing that book, that it was appropriate to include him, and I didn't want to make an exception of him, which would make it seem like I was doing it because it was him. Yes, my views are very different than his. Let me try to paint you a picture of his. First, he starts in the investment business in 1928. It's a very different world. It's a world of pencils, hand crank adding machines, and dusty libraries. It is not a world of computers. My father was very bright and he had good math skills, but he was not prone to think in a world then like you might think, even if you had primitive computers. So there were fewer stocks then, and he was a stock picker of a particular type. And in those days, almost everyone was. some kind of a stock picker of a particular type. This is long before, for example, passive investing. This is, without computerization, how do you do passive investing? This is, there were value investors, but the value investing as a discipline started at about the same time. Growth stock investing was actually older than value stock investing and was almost always stock picking. So, if you read my father's Common Stocks, Uncommon Profits book, he has his concept of diversification being bigger ones, mid-sized ones, smaller ones, A's, B's, C's, and he talks about them in terms of, if you will, how deeply rooted they are in the broader culture. His views are US only, not global, not even semi-global. This is before John Templeton emerges as the first to be somewhat outside of America as an investor from America. And even when John Templeton started doing that, he wasn't fully global and he was a stock picker. There's a particular way my father went about picking stocks, and I think it's fine. When I come along, I was a little more mathematical than my father to begin with. Secondarily, I started out as a stock picker. If you were to look at my Super Stocks book, it's a stock picker's book aimed at beat up growth stocks. My view was to try to find stocks a lot like my father's, but that were depressed for a unique reason that they would overcome. Just about that time, microcomputers start to come on the scene, and it becomes easier to look at the broader universe of securities. And I began to get a very simple concept, which was that whenever it was that big growth stocks did badly, small value stocks did really well. And whenever it was that big value stocks did badly, small growth stocks did really well. And vice versa. So if big value did really well, small growth did badly. And if big growth did really well, small value did badly. And once I got that in my brain, it took me about 45 minutes to leap from being there to saying, no style should be better permanently all the time. That every style should go in and out of phase, and that there probably might be some way to anticipate some of that. And I would get more diversification. I would be more consistent with the teachings of Harry Markowitz in terms of mean variance optimization. That would imply that a portfolio is more sound if it has some of the things that zig when other things zag, reducing the total portfolio volatility relative to the future expected return. In terms of the way Markowitz originally wrote about mean variance optimization about the time I was born. And while I wasn't trying to be an MVO person, I was trying to take advantage of the style opportunities, and that immediately extended to foreign. Because then the question becomes, if this category does well relative to that category, does it also overseas? And then what about industries, sectors? And so I started applying that concept, and I've been basically aimed at that ever since. And that's been a now multi-decade long adventure, and it's been good. And sometimes I've been in recent years very much prone to growth stocks, but I've also been a value guy, a growth guy, a big stock guy. I've sometimes been more prone to small stocks, and I'm always fully thinking global. I'm always looking around the world. And again, my father, in a world where he built his whole career and his maturity in a world of hand crank adding machines and pencils, couldn't have possibly been aimed at doing that. Look at what's going on almost every day. Not every day, but almost every day. When the market goes up, growth stocks go up more than the market. When the market goes down, growth stocks go down more than the market. When the market goes down, value stocks do better. When the market goes up, value stocks lag. The reality of that is if you believe that the market's therefore going to resume from this correction and a material up move, you'd believe that it would be led by growth stocks. Now, let me try to portray that in a different way. And I've written about this quite a bit. But in some ways, what happened in 2020 with COVID, which was technically a bear market because of its big magnitude, acted more like a giantly oversized correction because it was so fast. The drop was 3 weeks long, the bounce back was almost as fast, and we were off to new highs again. So in some ways, it acted like an oversized correction inside a bull market. Normally, I'm going to give you a rule of thumb. Like all rules of thumb, it's not perfect. But generally, when a bull market starts out in its early phases, value does better than growth. Why? Because if things had been as bad as people thought they would have been before, a lot of the value companies would be out of business. Value companies don't do well in terms of earnings in a bad economy. They're much more economically sensitive. And so if things would be as bad as people feared they would be in the depths of the bear market, then the value companies would be doing really badly and the growth companies would be doing better. So when things turned out to be better than expected, the value stock bounce. Normally, in the last stages of a bull market, growth stocks lead. Higher quality, fatter gross operating margins, and the ability to think farther off into the future in terms of survivability and growth. In the middle of a bull market, it's a battle between growth and value. And as this bull market started, unlike most, because it acted more like an oversized correction, the bear market, value didn't lead off the bottom. Growth led off the bottom. In the middle, value has been leading as the market has been doing this. And I think and believe, but may be wrong, that assuming we continue in an uptrend and the bull market goes on, that growth will lead. Now, let me try to tie this back to some teachings of my father, if I may. My father wouldn't say this quite these ways, but if you look at his Common Stocks and Common Profits book, without saying it in these words, he was saying you want two really important things in a stock, other than, of course, he was this big believer in great management. But you want the company to make what he called a worthwhile profit margin. And by that, he didn't mean net profit. He meant the gross profit. Gross operating profit margin, cost minus cost of goods sold. And then from that, if you've got a fat gross profit margin, like a 50% profit margin, that gives you lots of money to spend on marketing, selling, research, and anything else you need to do to grow the firm. Without a fat gross margin, it's very hard to grow a firm. If you've got a thin gross margin, like 20% gross margin, you don't have the money to spend on research, on marketing, on selling, and what have you. Those are all expenses below the gross line. So on the one hand, he believed have a fat gross margin and see what will they do to spend it on what to be able to use the profit to fund future growth, which would be some combination of those things that I said before. It could also, in theory, be covering the cost of interest to do acquisition. It could. But when I look at a company, I'm always saying to myself, first, what's the gross margin? And two, are they good at deploying what's left after sales minus cost of goods sold to generate growth? That's the definition of a growth company. And there's a lot of companies that people talk about being growth companies aren't really growth companies because they don't really have A and B. But if you've got A and B, then you've got something that you can think about as having a good longer term future. And late in bull markets, those kind of stocks tend to do very well. And when we look at some of the bigger ones, they have a proven ability at doing that. And those become ones that investors tend to like because it's easy to like the easy one. So I think whether it's not just tech, although it can be tech, but also, for example, some of the high-end growth companies in other categories, like in France, LVMH, which is a luxury goods growth-oriented company. It's not R&D, but they spend a lot of money on growth, and they have fat gross margins. Those kinds of things, whether it's tech or not tech, that's really the formula you're looking for. I would advise first that people shouldn't really, they do, but they shouldn't really think about emerging markets as a thing. Each of the countries is its own thing. And if you think about just think about some years back, they used to talk about the BRICS, Brazil, Russia, India, and China. Now, if you think about those four countries, think how different they are and think how differently the markets have behaved in the interim between then and now. Brazil is clearly not emerging. If anything, Brazil is submerging. India is very different than Russia. And China is exceptionally different than any of those three, as is South Korea, which is virtually a developed nation. And the reality and problem for South Korea is the dependence on a subset of tech and a few other firms dependent on tech. The reality of that is that those areas just recently have been unfavored by investors globally, not just in South Korea. An important thing for people to always ask themselves when they think about their own country being impacted in a certain way is, are the same types of stocks in other countries being impacted that way? Now, many of the smaller countries that are thought of as emerging in the category are really not like South Korea is, or maybe Taiwan is, more futuristic and technology oriented. Quite a lot of them are dependent on commodity orientation. And in many of them, the biggest companies are utilities and banks. And again, if you think of those sectors as what's driving their performance, that's as important or more important than the individual country. That's not always true. China, has been having difficulty for quite some time now in the stock market, as you know, and that's very Chinese specific. But China has never, I don't want to say never, has rarely had a very tight correlation to the rest of the world market. And hence I go back to my prior point. If you just look at the history of China, it is not correlated well with, let's say, the Morgan Stanley world or with IFA or with the US market. And I revert to my prior statement that you shouldn't really think about emerging markets as a thing. You should think about each of the countries individually. I'd like to think about you individually, and I think that you're the same as every other person from Korea. Pulling their money out of the Korean semiconductor stocks. But really, they've been pulling money out of semiconductor stocks pretty much everywhere. They're not focused on South Korea singularly. Mm-hmm. At the same time, this year, people have been categorically pulling money out of tech stocks across the board. That probably reverses when the bull market continues. But following what everyone else does and being a follower is almost always a mistake. They should think for themselves. They should see that if everybody's doing this, it's probably wrong. And it may continue a little longer, but probably doesn't continue very long. Trying to be a trend follower is rarely done successfully. Otherwise, all you do is buy things that had gone up, and it'd be easy. There was an American philosopher named Will Rogers who said he was also a comedian. I don't know if you ever heard of him, but he said famously, "Stocks are easy. You buy them, and then when they go up, you sell them." And then he's asked, "So what do you do if they don't go up?" And he said, "If they don't go up, don't buy them." And the reality of that is that trend followers, usually it works for a little while and then you get trapped because they get sucked down. And for the retail investor in South Korea, I would tell them, don't try to time short-term moves. And because Elon Musk is doing something does not mean that you should, because Elon Musk is inherently, I said this on Fox TV last Friday, Elon Musk is inherently unpredictable.
Oh, yeah.
I mean, Elon Musk could be doing something and be very vocal about it this week, and 10 days from now, he could be doing exactly the reverse and be just as vocal about it. Let's put some boundaries on what you said before. For decades, it's been true that passive as a category has done better than active. The reality is that means that the actives made decisions that were worse than doing nothing. What that means is that the active investors didn't know what they were doing, somehow, some way. In finance theory, and I believe in reality, the basis for making a trade is to somehow, some way, know something that other people don't, so that it isn't already priced into the stocks. Inherently, most active investors are trading all the time based on the same thing everybody else is trading on. And they don't know anything other people don't know. So they're all doing this, and most of them, not all of them, most of them have to end up losing because of it. When I say losing, I don't mean losing absolute dollars. I mean doing worse than if they had just been sitting there passively. Knowing something other people don't know is the holy grail and is not easy to do. I always say to people that want to trade a lot, what do you know that other people don't know? And the answer is almost always they know nothing that other people don't know. The average active investor is trading based on thinking that he or she is smarter than other people who are looking at exactly the same information. And they forget that it's not about being smarter than the other person. And they may be smarter than the other person, but it's not about smarts. As Warren Buffett has always said, or Charlie Munger's always said, this isn't about the one who's smartest wins. It's about the one who does the right things wins, which puts wisdom over thinking you're smart. And wisdom argues to not trade a lot. It argues to only trade when you believe you know something that isn't what everyone else is doing. That's not easy for people to do, because as soon as everybody gets all agitated about something, an awful lot of people want to trade on that, thinking that they know what to do about that, which is other people are agitated about, whether it's the war in Ukraine, whether it's interest rates, whether it's inflation, whether it's what happens in politics, whether it's. The reality is the reason active, in my opinion, has done worse than passive and will continue to do worse than passive, not for everybody, but for the average active investor, is the average active investor will keep being his own worst enemy. Uncertainty ends up being rewarded. It's just a matter of patience. That has nothing to do with whether stocks are higher 3 weeks from now or not. And there is way too much focus always on trying to figure out where the market's going to go in the very short term, even where the market's going to go in the intermediate term. That isn't very important. What's important is where the market's going to go in the long term. And whenever uncertainty in the minds of people is very high, that's a much better time to buy things or hold them than when uncertainty is felt to be low. There's a age-old saying that if you want certainty, the stock market is a very expensive place to buy it. The reverse implication of that is it's actually very cheap to own uncertainty. If people were not talking about interest rates a lot right now, if people were not talking about inflation a lot right now, if people were noticing things and focused on things otherwise, like why things are going to be great, then it wouldn't be such a good time. But all of the myriad fears that we have, which are archetypal of the way it is in a correction, the uncertainty reduces the risk. It doesn't increase the risk. The appearance of risk reduces risk. Risk is a ghost. Risk is a dangerous ghost. Risk is something that you don't actually see easily.
I did the study of what is now happening. I like to look at history to understand the cause-effect relationships that have happened many times in history, to understand how to navigate current circumstances. And I did that as a study. And also, I'm now at a stage in my life where I'm passing along what I believe is valuable information rather than keeping it to myself, because I'm at 72. And so at that age, I want to pass along what I consider to be valuable information. So I did the study for myself and for Bridgewater, my company, to understand how to navigate what's happening. And I passed it along because I think that that's my responsibility to do at this stage. You can't separate politics and economics. In fact, politics now is having a bigger effect on economics and markets than anything else. We've moved from an environment in which economics would determine resource allocations. We're now in an environment in which political circumstances and geopolitical circumstances have a much bigger effect than ever before, except for the 1930s. I've been doing this for 50 years in all different countries. We're in every liquid market in the world. And normally, fiscal and monetary policy and tax policy and foreign exchange controls are always a consideration, and they're especially important now. We know that we are on the edge of war. We can't say whether we are 3 feet from it or 6 feet from it, from this cliff, but we are at the edge of war, and it is intensifying. So what will probably happen is more intensive sanctions, and that could lead to some military confrontation. We don't know. But we know that if you follow these stories and you follow the sequences, when there's an acceleration of painful economic actions designed to hurt the other side. So, for example, if there is a move by the United States administration to prevent investment in China or business with China, that would have very big implications to the rest of the world because of how intertwined the economy is with China. We're at the edge of that. It could be that Russia, it could be like investing in Russia, that companies are not considered to be good citizens or good participants if they continue to invest in Russia. It's very close to that now in the United States. It wouldn't take much. That would make economic conditions much worse because of how intertwined the economy is. There will be movement to make it more self-sufficient because both leaders of countries don't want that vulnerability. That makes it inefficient, production inefficient, and that produces more inflation. So that's where we are. Now, how far that goes, in World War II, the Japanese were sanctioned by having their assets frozen and oil supplies interrupted. That led them to Pearl Harbor. You have similar tensions now pertaining to Taiwan. I don't know exactly how it will, but I know that it's a very risky situation. If you take the world order, in other words, the world system, it goes from one new world order to the next world order that follows wars, typically. So, for example, in 1945, after World War II, the United States was the dominant power. It had 80% of the world's gold, which was money. So it had 80% of the world's money. It had produced half of the world's GDP, and it had a monopoly on nuclear weapons and weapons. It was militarily dominant. And so in all of those cases, there's a war and there's an international world order, and then there's a country world order. Country world order means what rules the country. So sometimes there are civil wars to determine who the ruler of the country is and the system that's operating. And sometimes there are world order changes, but they usually follow a war for the dominant control. Then they begin a cycle. After a war, there is usually a consolidation of power by the leaders, and there's a period of peace and prosperity, which comes from peace because nobody wants to fight the dominant power, and peace also because people want to go beyond wars. And there's a rebuilding and a prosperity period. And the most important thing that happens then is good education. Societies rise because they educate their population well, not only in skills, but also in civil behavior, how to behave well with each other. And there's a rebuilding. And usually in all of the civilizations going back over the last 500 years, there is a capitalism of sorts. We saw it in China, in which resources are provided and people with ideas come up with ideas and they build those out, working with investors who provide them capital. And that's the capital markets. And over a period of time, that produces more debt, and it produces larger wealth gaps, because as wealth is distributed, it's distributed to those who produce the best results, and it produces, some cases, big wealth, some cases less. Different societies handle that differently. Some of them have bigger wealth gaps. Some of them reinvest in education. And so a very big important consideration is how much debt is produced, because the development of the capital markets tends to produce a lot of debt, because debt is stimulative. When you create credit, you create debt. In the world, in this cycle, the dominant powers in the world invent new technologies. For example, the Dutch invented ships that could travel all around the world, and they bring their money all around the world. And so a dominant power in the world will also bring its money around the world, and that will become its major currency, which is called a reserve currency. It is the commonly used currency. And because it is commonly used, many people, many foreigners want to save in it. So they save in it, and the way they save in it is they buy debt in it. They buy bonds, for example, and so they accumulate it. So it's used for transactions, and it's saved in by foreigners. But that also contributes to the debt of the reserve currency country, because they have that lending. So the other side is that they get more into debt, typically. Then with time, that gap with other countries narrows, because other countries begin to develop their own capabilities and their own educations, and they use that savings to raise their living standards, and that gap narrows. So it typically, at the top of a country, you see a lot of debt, and you see reduced competitiveness in relationship to other countries. And as they get power, they compete economically, and you see that they get richer, very much like China has done and other countries have done. Korea has done. They've got richer and more powerful in their own ways. And if they're big powers, they develop many types of power. They have a power of education. They have a power to develop of competitiveness in world markets. They have a power of military. And over that period of time, then a power gap narrows. So three things happen when a country is at risk. First of all, they have very large debts, and they print money. A sign of the early decline is the printing of a lot of money, because they don't have much money and they want to stretch it. And so that's one. So a lot of debt and money printing is a sign. The second sign is a lot of wealth gaps in the country and internal conflict in the country. Because with the internal conflict over wealth and values differences, that causes an internal tension. And then also these competitors who create comparable power, comparable economic power, comparable military power, become rivals. And then traditionally, there is another war for determining who is the dominant power. And then the winner of that begins the next world order. So that is a brief description of the cycle. That cycle can last in history. It's typically lasted about 100 to 150 years. Sometimes it's gone as long as 250 or 300 years, or as short as 50 years. The United States has all three of these issues now. And there are, in my book, it was my study, I like to measure things, and you can measure health. So I showed 18 different determinants of health that you could see, and you could see graphs. And those 18 measures include the level of education, the level of corruption in a country, how many natural resources they have. So there are many things that enter into being healthy and being strong. There are 18 measures in the book, but I'm highlighting the most important in making this cycle. But it's still strong.
Yes.
Okay, so just to be indicating, it's strong in different ways. It's strong in the inventing of new technologies. It's strong in excellent education at the top level. It has the best universities and university research centers. It's strong because it still has the world's reserve currency. It's strong so it's strong in many ways. And then in many ways, it's weakening in the ways that I described. In other words, it's weak in its indebtedness and so on, and it's weak in the ways I've described. And then the gap with other countries, most importantly, the gap with China, has narrowed so that they're approximately comparably strong, not precisely. And then there are different ways of measuring it, but it's comparably strong in important ways. Like it doesn't have the same amount of superiority in some technologies. China has larger population of engineers and that. So militarily, it depends on where you're looking at that. So we have now a much more comparable comparability between the United States and China. And also the internal conflict in the United States and the indebtedness is very bad. A few things I'll highlight. First, in all such periods, debt assets are not good assets. They will lose value in relation to inflation because governments will print a lot of money to produce a level of inflation that is above the level of interest rates. So first, and then conflicts make debt riskier to have. During this economic warfare, for example, sanctions are playing a role in which governments are now considering, could they be sanctioned and what are the best assets? So one of those considerations is the issue of debt assets. The second is very big differences between countries. There are three things that I look for in trying to decide what countries to invest in. And they are Is it financially healthy? I measure the health by whether their earnings are greater than their expenditures and whether their balance sheet is strong. Countries in which they have good income statements and good balance sheets are safer than those that don't. The second is, do they have a high level of internal conflict or external or not? If they have a lot of internal conflict, I'm more concerned about those for wealth. And then third, are they at risk of an international war or are they neutral? Countries during such times that are neutral do better. We also look at to what extent are they, if they're in a war and they're not, if they're at risk of war and they're not self-sufficient, I'm very concerned about that, because that absence of self-sufficiency can be a problem. We are also in a period of time of questioning what money is. What is good money? Money, one holds money in a debt instrument. You don't hold it in actual cash, you hold it in a debt instrument. There are two purposes of money: a medium of exchange and a storehold of wealth. These debt instruments are not good storeholds of wealth. And so money is something that is mobile, can go from country to country, can be accepted in all countries, and is a good storehold of wealth. So as we think about that, the world is in a phase of what is safe. What is a safe investment? So we're in a period that is likely to be a period of stagflation. In other words, higher levels of inflation and lower levels of growth, and an environment in which debt instruments is not going to be good, and that picking the right countries with consideration is very important, because now we are not in an environment where economics is going to be the main driver of things and profits. We were in a period of time where money would go to places wherever it could be produced most efficiently. And there would be competition, and that would raise living standards in some places. If you were more competitive, your living standards would rise in relationship to places that are less competitive, and money would move around to help that happen, motivated by profits. We're now in an environment in which ideologies, politics, and geopolitics will affect how resources are allocated, because that is considered a higher priority. That will happen within countries and between countries. And we're seeing that happen. So that's why you're seeing supply lines change and self-sufficiency change. These things are important to keep in mind in investing. That's because there is a dynamic underway in which holders of debt instruments will not receive a high enough return to compensate them for inflation. And there's a tightening of monetary policy to try to deal with inflation, but it won't be high enough. So a high enough interest rate to prevent the selling of debt instruments and provide an adequate return would be too high of an interest rate for the markets and the economy. Central banks try to have a lower level of inflation and a higher level of real growth. And the trade-off sometimes becomes very difficult and sometimes it's easy. In this period that we're going ahead, because there's so much debt outstanding, and because one person's debts are another person's assets, that balance is much more difficult. And so for those reasons, and also for the geopolitical reasons that I mentioned, in which efficiency and profitability are not as important as security, that these considerations are more inflationary and also reduce the efficiencies and therefore reduce growth. So that combination of circumstances appears to be very stagflationary. I think you must be referring to the 70s, and then because in the 1970s, the stock market and bond markets did very poorly in inflation-adjusted terms, and then very, very poorly. And the bottom was made in August 1982, when Mexico defaulted on its debts, and there was a number of defaults. So that was the bottom in 1982. And then we had a bull market in both bonds and stocks in the 1980s. So I think you're probably referring to the 70s. What happened in the 1960s, United States ran very large deficits, spending money on both the Vietnam War and many programs, outer space program and a poverty program. And back then, the money was gold. And you had paper money that were like checks in a checkbook. And the United States ran very large deficits and printed a lot of claims on the gold, more than there was gold in the bank. And then on August 15th, 1971, the United States defaulted on that. They said you could not get your gold. And then they printed a lot of money. There was no restraint. And we had the inflationary 70s. And that produced a paradigm shift, because before that, there was less worry about inflation. And then, so in these paradigm shifts, which typically last about 10 years, there is a big movement in the opposite direction. So people start to protect themselves against inflation. That means they sell financial assets and they buy real assets. And then we had two waves of inflation. And so that period lasted until the end of the 70s. In 1980 and 81, there was very tight monetary policy, which broke the back of inflation. So this is very similar to that, because there's a lot of money and debt creation that's taking place. And we're beginning an adjustment in which holders of debt are then selling that debt because it doesn't compensate them for inflation. And then more inflation is being adjusted in prices. So there's a change in inflation psychology, as well as a change in some of these other determinants of inflation. And that contributes to the period of greater inflation. So I think it's similar, not identical, but similar. My job is to think differently than the consensus and be right, because the consensus is built into the price. So the way that one succeeds is to think independently and to ideally think better than the consensus about what's happening. And so that's my business. That's what I have to do. I have to be one step ahead of that, the crowd.